Thanks for joining me in my market report. My name is Mike, and my market report is on mortgage rates. If you're new to my videos or my channel, well, we kind of get the nitty-gritty items out to you as to what's impacting mortgage rates on a daily basis, whether it's something from an economic calendar that report that came out, or something on the headline news, or some geopolitical data that came in, and that's affecting the markets. If you're not aware, mortgage rates are run on mortgage-backed securities, which are packaged and traded on Wall Street. So that's why are not finite all the time. They do change quite a bit, and can we could have a couple price changes in a single day, just like the stock market would dictate on a stock price for an individual stock. So, a little bit about myself is I am a loan officer. I do work with a national lender. We do loans in all 50 states. So, if you guys are looking to refinance or purchase, we're here to help you guys out. If you guys got questions about anything in regards to mortgage programs or rates out there or anything, we can be of assistance. Again, reach out to us. We're here to help you guys answer any questions you might have. Without further ado, we'll jump right into the video today. We'll start off with our economic calendar. Now, every Thursday we get the jobless claims. This week is a big week for jobs because we'll get tomorrow the Bureau of Labor Statistics data. Yesterday we had the ADP, which came in very high. It came in actually twice as much as what the forecasts were. So that was a pretty hot number here. So this week, again, this is for last week. So last week was revised slightly. Last week's report actually from 198,000 to 200,000. Forecast is calling for 197,000 for last week, and it came in at 207,000. So remember, these were pretty much a short week because we did have the holidays, uh, and again, we'll kind of wait and see what transpires into like coming this week for next week's report, and then going forward as we end the seasonal. We get a lot of seasonal jobs are hired during the holidays, and a lot of those people are let go, and we'll kind of see how the jobs data uh, move once we get to those levels here. Um, we also got the factory orders. So factory orders back in October were revised slightly higher from 1% to 1.2%. Forecast was calling for 1.5% in November, and it came in pretty close to expectations, but slightly higher at 1.6%. Now, last but not least, we got the non-manufacturing by ISM business, or I'm sorry, non-manufacturing ISM non-manufacturing PMI. This is the services sector by ISM. Anything above 50 is considered expansion. So as you can see here, we are at 69.1 back in November, which is extremely good. Forecasts come for 66.9, so a slight pullback. It pulled back a little bit further to 62 on this here. Now, something we're going to touch on, don't always go on it, but as you can see here, continuing claims did rise a little bit from 1.718 to 1.754. So we did go up a little bit instead of coming downwards on the continuing claims. And then challenger layoffs, it jumped dramatically. We went from just under 15 million to up to 19 million announced layoffs here. So that's a pretty big drastic turn in terms of layoff announcements. Now let's go ahead and take a look here at the mortgage-backed securities and see what rates are doing, and we're not looking so well. Yesterday it dropped dramatically again after we had the FOMC minutes released. So the ADP kind of dropped it. We were down about 20 basis points, and it dropped like another 20 basis points after the Fed announcement. And today we're kind of continuing that trend. We are at much lower levels than what we had anticipated. The lowest levels we were at, as you can see, over the last 6 months or so. So even back when I'll show you something else on the Treasury. Even when we're touching certain levels of the Treasury, we're in a much lower position than before from like October and November. So even when we hit certain levels in October and November, we are beyond that. So as you can see here, you know, we're still at the 102. We're still about 101, high 101s right here in these levels here. And we're way down here to 100.95, so just under 101 right now. All right, so right now we're down 17 base points. So this translates to, again, another day as we pretty much all week, every day, we've gotten worse in our pricing. So our pricing has worsened a bit. as a result, as you can see here, it's a pretty dramatic shift from Friday's close all the way down, or yeah, Friday's close all the way down to what we see here today. And let's take a look here at today's volatility. It's been pretty consistent today, actually. It hasn't done a lot of movement today. As you can see here, we had the quick shift and then kind of more or less in this movement here. It was like minus 23 for the most part all along here, and just recently kind of improved slightly to like minus 17 right now. But for the most part, it was down about 23 basis points from for a good portion of the morning so far, and then kind of just recently kind of shifted to a minus 17 as that result. All right, so here's what I'm going to talk about with the Treasuries. As you can see, the Treasuries, um, see here before we were at these levels here in October, November, and then we were already past that. We were already surpassing that. So we're hitting two new levels right now. It looks like we could potentially be now. Before it looked like those were our caps, and we would bounce back and get some improvement. But it looks like we're not getting that. It looks like we could be actually on our way to worse pricing and continue on there. And why is that? Yesterday, we had the Fed release their minutes yesterday. As I indicated, it dramatically worse, but it did give us a little bit more insight onto one other thing that investors probably did not expect. Not only were they talking about raising rates that they're talking about and then the tapering, but typically what the Fed would do is they would, when the securities, mortgage-backed securities or treasuries, when they come to the maturity level, they would reinvest those dollars back into those. And now they're saying they're trying to reduce their balance sheet and reduce the balance sheet is they're not going to go ahead and reinvest that money back into the markets. So what does that mean? It's going to be basically meaning that rates are going to continue to rise further. That's going to be further push to raise rates from what they currently are as a result. So just kind of want to give you heads up on that we got that extra layer now that's going to be adding more pressure on mortgage rates as well as the 10-year treasury and stuff. So that means less bounce and more more demand. So we're not having a lot of that out there. So less demand by the Fed. All right, so let's go ahead and take a look at our national average for conforming loan limits rates right now, and we'll start off with the 30-year fixed at 3.34 right now, and then the 15-year is coming in at 2.69. These do have points built into them. Again, if you follow my programs, if you want a rate quote, just go ahead and reach out to us. We can talk a little bit more about that. There is no one size fits all, so what you see here or what you see on billboards and stuff like that don't always translate. We do get a lot of things that get there's a lot of things that go, a lot of variables that go into quoting a rate for a person, and that's why it may not always correlate when you talk to other friends or family members, what kind of rate they got, type of thing. All right, so anyways, we're at the end here. You guys have a great rest of your day. We appreciate you guys viewing. If you guys like these videos, please help us out and smash that like button and share. We greatly appreciate you guys, and thanks so much for watching. And again, we're here. If you guys need anything, got any questions, please reach out. We're here to help you guys. Take care, and look forward to see you guys in tomorrow's video. Bye-bye.